Welcome back to the ProTicker podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. Today, we're really cutting through the noise, trying to bring you the most important nuggets of knowledge. You know, the financial and geopolitical forces shaping our world right now. Our mission, really, is to give you a shortcut to being truly well-informed.
And we've pulled together quite a collection this time. Recent articles from outlets like CNBC, Bloomberg, Yahoo Finance, all published around August 12th and 13th, so very current. What's really illuminating, I think, isn't just the individual headlines, it's how they knit together. You see these new economic policies over here,
Yeah.
and then shifts in global power dynamics over there. It's not just what happened, it's understanding those ripple effects across the whole financial landscape.
Absolutely. And today, we're embarking on a deep dive into something pretty pivotal. We've got the One Big Beautiful Bill Act, OBBA, and its market impact. Then there's the latest on inflation, interest rate bets, plus the ever-present saga of global trade and tariffs, some geopolitical flashpoints heating up, and, of course, how specific companies and sectors are reacting. So as we look at all this, what's the thread? What connects these stories for our listener?
If we connect this to the bigger picture, it feels pretty clear we're at a turning point. Government fiscal policy, how government spend and tax, and that's really becoming a dominant force. It's shifting investor strategy alongside what central banks are doing, and of course all these geopolitical tensions. It's a complex web, no doubt, but seeing those connections, that's key to figuring out where the market might be headed.
Okay, let's unpack this then. Starting with the One Big Beautiful Bill Act, OBBA, our CNBC source, Big Beautiful Bill sectors investors are betting on and avoiding, calls it a pivot point. What jumps out at you? What's maybe surprising about its design or the immediate market reaction?
Well, a key takeaway from that CNBC piece is Peter Anderson's point. He says the U.S. is moving from monetary stimulus to fiscal muscle. This bill, passed back in July, it isn't about the Fed pumping money in. No, it's about big tax reforms, selective incentives, really targeted government spending. Tat Waito over at RDC Wealth Management Asia even calls it the next fiscal supercycle, meaning we're likely heading into a long period where government spending, not just market forces, actively shapes key industries. Think AI, defense, logistics, electrification. Now it's also forecast to add to the deficit, got criticism from credit agencies. So it raises that important question, right? Is this truly a new era? Or, like Cody Willard suggests, is it more of a continuation of constant fiscal spending promises we've heard before? The difference might just be the scale and the focus this time.
Right, and that leads straight into inflation and the Fed, doesn't it? If we're seeing this kind of fiscal muscle flexing, how's that hitting the other big lever, the Federal Reserve's stance? We saw Bloomberg's piece, bets on outsized Fed cut gain steam, and CNBC saying the inflation jump scare is not here, at least not yet. Looks like the July CPI report was pretty mild.
It was, yeah. The headline annual rate, 2.7%, was actually lower than expected, and that really bolstered the case for interest rate cuts. Treasury Secretary Scott Bessent even floated the idea the Fed should consider a bigger cut, a 50 basis point cut next month.
0.5%. That's pretty aggressive compared to the usual quarter point.
Exactly. But there's a catch. The underlying inflation rate, that actually accelerated in July, the most since the start of the year. So that raises questions, about the accuracy, about future impacts, especially from tariffs. Jan Hatzius at Goldman Sachs, their chief economist, he estimates consumers could start seeing higher prices by October, directly because of this. And you see it in the markets. JP Morgan Treasury clients, they cut their long positions. Options traders, they pushed September rate cut odds up to 90%. Some contracts could apparently pay off $40 million if we get that 50 basis point cut. So there's real conviction there.
And tariffs. You just mentioned them as a potential inflation driver. Yahoo Finance reports a new monthly record. Tariffs bring in record $27.7 billion in July, as Trump calls haul incredible for our country.
Yeah.
But the big question is, who's actually paying that bill?
That's the critical point. The administration says companies foreign governments pay. But economists, including Goldman Sachs again, they predict consumers could foot about 67% of those costs by October.
67%. Wow, that's a huge jump from the 22% estimate a few months back.
It is. And the overall U.S. effective tariff rate, projected to hit 18.6%, that'd be the highest since 1933. Meanwhile, Bloomberg highlighted Secretary Bessent's stance, no Chinese investment in critical U.S. industries as part of a trade deal. He linked it directly to reshoring efforts, pushing production away from China. And CNBC reported the White House is working out the legality of those NVIDIA and AMD chip deals with China. They now include a 15% export tax. So it all points to this continued mix of trade, national security, economic policy. Tariffs seem less about revenue, more about strategic industrial control.
So with these big policy shifts, this fiscal muscle, the trade dynamics. Where are investors putting their money? Which sectors are they betting on, and which ones are they avoiding? That CNBC source on the big, beautiful bill seemed pretty clear.
Yeah, strategists see this industrial restructuring happening. The sector's looking good, mostly industrials and technology plays. Specifically, companies involved in what they call dig, build, ship, power, and protect.
So like heavy electricals, infrastructure firms.
It's exactly. Oil field services, defense contractors, even banks that might see more loan demand for all this activity. Peter Anderson highlighted infrastructure as the most exciting aspect. But it's not just bridges and roads, it's firewalls, data security too. The OBBA puts $150 billion towards defense, funding for drones, military infrastructure, AI. They're calling cybersecurity the new front line of national power.
Right.
And tech, of course.
Yeah.
Especially AI hardware makers, companies deploying AI. They stand to gain from R&D incentives, productivity boosts in the bill.
And this tech momentum, it's not just talk. We're seeing it in earnings, right? Yahoo Finance noted big tech is driving the stock market to new records. The S&P 500 hit a new high, mostly thanks to those large-cap tech names.
Yeah, and what's fascinating there, nearly all the top 20 outperformers in the S&P 500. They have some kind of AI growth story. It's not just the usual tech giants. It shows AI is spreading through the index, way beyond just the traditional tech sector. It's driving returns now and setting up future opportunities as more companies use AI to boost margins, productivity. One analyst, I think it was in the Yahoo piece, called it the early innings of the build-out. Still lots of room to grow.
But it's not all smooth sailing. That CNBC article on OBBA also mentioned underweight sectors. So where are the potential downsides? Which sectors might face headwinds from these policies?
Well, that raises an important question, doesn't it? Clean technology is one clear area. Investors like Peter Anderson suggested solar and wind power will not be great positions to be in. The bill speeds up the phase-out of some clean energy tax credits, and it brings in these really strict foreign entity of concern restrictions.
So if you rely on components or investment from China, Iran, Russia?
Exactly. Those projects face major limits. Companies might have to totally rethink their supply chains, could drive up costs. RBC's 2 also mentioned reimbursement pressures for hospitals, managed care sectors. So maybe some headwinds for parts of healthcare too.
Okay, let's shift gears a bit. Beyond the economy, lots of geopolitical activity, and these shifts have real economic ripples. Let's start with China and the U.S. in the South China Sea. CNBC highlighted that incident.
Yeah, that's a prime example of these simmering tensions. China claimed it drove away the USS Higgins, accused the U.S. of infringing its sovereignty, entering territorial waters illegally. But the U.S. 7th Fleet says, no, the Higgins was doing a freedom of navigation operation. Standard practice under international law. They won't be deterred.
And this is about Scarborough Shoal and the 9-line claim.
Right, which an international court rejected back in 2016. But the dispute continues. This latest incident comes amid the trade spat, follows recent clashes between Chinese and Filipino ships. Tensions are definitely rising, and the U.S. has that mutual defense treaty with the Philippines. Remember, President Marcos Jr. said killing a Filipino citizen there would be a red line. Very, very close to an act of war.
That raises the stakes significantly.
It does. That kind of instability directly impacts shipping lanes, global trade. It's not just a regional issue.
Okay, moving over to the Middle East. European powers threatening snapback sanctions on Iran, that's according to CNBC. How critical is this for global stability and maybe energy markets?
It feels like a really critical moment. France, the UK, Germany, they told the UN they support reinstating sanctions by August 29th if Iran doesn't get back to nuclear talks. The EU had warned about this back in mid-July.
And this is because Iran's enrichment level is getting close to weapons grade.
Exactly. It's reached 60% purity. It's just a short technical step away. The last talks broke down, you'll recall, after Israel and the U.S. reportedly bombed Iran's nuclear sites in June. So the stakes are incredibly high. Iranian officials have even hinted they might pull out of the Nuclear Non-Proliferation Treaty if sanctions come back. Any escalation there, you'd see an immediate impact on global oil prices and supply chain security.
And then we have the upcoming Trump-Putin summit. The White House seems to be taming expectations based on that CNBC report. What's the core concern here?
Well, the White House spokesperson, Caroline Leavitt, called it a listening exercise. And she noted, importantly, that only one party involved in the war would actually be there. There are definite concerns, especially in Kyiv and among European allies, that Trump might push for some kind of peace deal involving Ukraine giving up territory.
Land-swapping idea.
Yeah, that idea has been floated. But President Zelensky has been really firm. No surrendering ground. Ukraine must be included in talks. And the EU's foreign policy chief, Kaja Kallas, she basically said she thinks Putin is just pretending to negotiate, using it for a photo op and to try and postpone sanctions. You see how it all connects. The U.S. just slapped an extra 25% tariff on India. Why? Citing its Russian oil purchases, geopolitics, trade, economics, all tangled up.
Let's try and connect this back to global commodities then. We saw reports from Bloomberg and Reuters forecasting a pretty big shift in oil markets. Bad news for producers, maybe good for us.
It looks that way. The International Energy Agency is predicting a record supply glut next year. Why? Slowing demand growth, plus swelling supplies. Oil inventories hit a 46-month high back in June.
And prices are already down this year.
Around 12% lower, yeah. Crude's trading near $66 a barrel. So like you said, that offers some relief for you, the consumer, at the pump. But it's a real financial threat to oil companies in oil-producing countries. OPEC Plus has eased output a bit, but what their long-term strategy is for market share in this kind of oversupplied market, well, that remains unclear. Though interestingly, the IEA does expect global oil refining runs to hit near an all-time high this month. Suggests demand for gasoline, diesel, etc. is still pretty strong, even with all that crude sloshing around.
All right, let's zoom in on some specific companies. First up, the crypto world. Circle and Bullish making headlines in CNBC and Bloomberg. Kind of contrasting stories, aren't they? What's that tell us?
It shows a bit of a mixed bag, yeah. Highlights different appetites for new crypto offerings right now. Circle shares, according to CNBC, fell over 5%. They announced a public offering of 10 million Class A shares. Common shares usually with specific voting rights. 8 million of those are from existing shareholders selling off. This came after the stock had soared, over 450% since its IPO in June, even though they posted a Q2 loss because of IPO charges. Revenue was up, though, thanks to stablecoin growth.
But Bullish went the other way.
Completely. Bloomberg reported Bullish raised a huge $1.1 billion in its IPO, priced shares above the range, was 20 times oversubscribed, and you had big names like BlackRock, ARK Investment Management showing interest. So, yeah, the contrast suggests the market's being picky, but there's still serious demand for crypto firms that seem to have strong fundamentals and a good growth story.
Okay, other earnings news. Seeing some struggles for consumer-facing companies. Yahoo Finance reported Kava stock plunging, CoreWeave sliding. What's the story there?
Well, Kava shares dove about 23%. They cut their annual sales growth target, reported only 2.1% same restaurant sales growth. That suggests it's getting tougher for these high-growth consumer stocks. We heard similar cautious notes from Chipotle, Starbucks. Seems like consumers might be tightening their belts a bit.
And CoreWeave. They're in the AI space. Shouldn't they be booming?
They beat revenue estimates, yeah, thanks to strong AI demand. But they saw big losses. Why? A much higher net loss plus huge capital expenditures. Up $1 billion sequentially, another $500 million expected. There are concerns about their high debt load, too. Raises questions about sustainability, even in a hot sector like AI infrastructure. They'll likely need maybe $10 billion more debt to fund their data center expansion plans.
Speaking of consumer trends, what really caught my eye for travelers was Jim Cramer's take. Expedia versus Airbnb. That was in CNBC. Who's he backing?
Cramer prefers Expedia. He cited its laser focus on value and what he called unambiguously robust guidance. Expedia actually raised its full-year forecast for bookings and revenue growth. Plus, their business-to-business division gives them a real edge.
And the Airbnb.
They had more of a mixed outlook, making these big bets on new, pricier services beyond just home rentals, targeting wealthier consumers. Cramer thinks that's risky right now. Consumers seem more value-conscious. It kind of reflects that broader economic trend. People are thinking twice about discretionary spending.
And tying some of this together, Cramer had some broader advice in another CNBC piece. Basically, stay the course. How much should these big macro-political events really dictate your individual investment decisions?
That's always the million-dollar question for long-term investors, isn't it? His argument is, look, selling just because of political news often means you miss the rally. Because the underlying issues that made you sell, they usually don't get fixed until after stocks have already bounced back. He emphasized that major companies, they're still making tons of money. They've adapted to a mercurial president, managed to shift supply chains, make deals. So it makes you think, right, geopolitics definitely creates volatility, but maybe the fundamental profitability, the adaptability of big corporations, maybe that's a more powerful long-term driver for your portfolio.
Okay, one last thing. An interesting, maybe slightly concerning development on economic data from CNBC again. Trump's pick for the BLS commissioner called for suspending the monthly jobs reports. That could really shake things up.
It could, yeah. After that slower than expected July job growth number, Trump fired the previous BLS commissioner. nominated E.J. Antoni from the Heritage Foundation. Antoni has publicly questioned the accuracy of the monthly reports, suggested suspending them, maybe moving to quarterly data, until the methodology is, quote, in order. Definitely raises an important question about the integrity, the reliability of these key economic indicators Wall Street leans on so heavily, especially since Trump also publicly criticized Goldman's Jan Hatzius for that prediction about consumers absorbing tariff costs. It just shows how economic data itself can become a political flashpoint.
Wow. We have covered a tremendous amount of ground today, from the shifting U.S. economic policy with the one big beautiful bill to that nuanced dance of inflation and interest rates. We also dug into big tech, AI, the complexities of global trade, tariffs, and explored those tense geopolitical situations. South China Sea, Iran, the upcoming U.S.-Russia summit.
And what really becomes clear, I think, is just how deeply interconnected all these forces are. Investor sentiment isn't just being shaped by targeted government spending anymore. It's being shaped by these global political chess moves, too. The real aha moment here, maybe, is realizing that every major financial decision now, a new bill, interest rate bets, it's fundamentally a geopolitical play as well. Understanding who benefits from this global shift in industrial policy, how nations are using economic tools strategically. That's the core insight, I think, from this deep dive.
So as you, our listener, reflect on all this, consider this question. In an era where fiscal muscle is replacing monetary stimulus, where geopolitics directly hits markets and trade, what does that mean for how you assess risk, how you look for opportunity?
Yeah, think about how these shifts might force businesses, maybe even governments worldwide, to innovate or pivot, not just reacting to market signals, but to these undercurrents of international relations, domestic policy. It raises that big question. Are we entering a long period of government-led industrial policy? And how is that going to reshape global supply chains, competitive landscapes, maybe for decades? Definitely something to keep exploring.
Absolutely. Lots to think about.
We'll see you all tomorrow morning with new headlines from major financial magazines.